Okay, on today's episode of the Investing City podcast, super excited to have Richard Chu. So thanks for being here, Richard.
Thanks for having me, Ryan.
Awesome. So why don't you just talk a little bit about your background? How did you get interested in investing? And then we'll kind of go from there.
Yeah, so first of all, I just wanted to say that I'm really honored to be on your podcast today. Like, you've had so many people that I respect and admire on before, like other hedge fund managers, CEOs, technologists, and like I'm someone who just finished my undergrad last year. So yeah, it's really like an honor to be on. I'm based in Canada right now. I'm working remote for Saga Partners. You guys had my lead PM, Joe, on before, and Michael, which is the other PM of Saga, recently announced that he'll be offering additional portfolio strategies under the name Lugo Capital. So even though Saga won't be managing these strategies, I'm going to be assisting with both of them. So just to give you like a background on my investing journey, I didn't start very long ago. I just started in 2018. Back then, I didn't have much interest in stocks, and it was mostly because I didn't have much exposure. So like my family doesn't like, they aren't really big into investing. My friends weren't either, and the stuff that I was learning in school wasn't very inspiring either. I also didn't have much money back then. So when I did get started, it was very generic. Like I was working, I was doing a summer internship at PlayStation at the time, and I had some extra money laying around. So I invested in a couple of personal finance books, and that really taught me the importance of compounding. And I really learned that there are like three parts to the equation. So first is the length of time that you invested. Second is the amount that you contribute. And third is the returns that you're able to generate. So I solved the first 2 points because I started immediately. And I was also putting in like the majority of my savings into the market. And the third point, which was maximizing my returns, was something that I realized I needed to work on. So what I did was I started out by investing in the stocks in the companies that I knew about. My first investment was in Facebook, and that was after, if you can remember, their disappointing Q2 2018 earnings. So back then the bears were really like out in full force, and there were like a tons of concerns, both around like the user growth as well as privacy and the fact that they weren't guiding for great numbers either. So like it was a stock that I knew, it was a company that I really understood. So I invested in it, and it turns out it didn't do too well because it kept declining into the December 2018 crash. But what it did do was it motivated me to take a more serious attitude to investing. So I started by searching for mentors and other like advice online wherever I could. I would buy subscriptions to the Motley Fool. I would join online investing communities, and I was also reading a lot. So like for me personally, I don't come from a tech background. I did my degree in commerce. So it took a while for me to really understand and get into what all of these software companies were doing. But the aspect of investing in these really like hyper growth software companies that were actually needed by every single company in every single industry, you know, like the saying that every company is becoming a tech company. I think that's already like pretty popular now, and it's really playing out after COVID actually. So that was really appealing to me. And I started to really build my investing approach around identifying and evaluating these long-term compounders. But the problem was that like I, like most people, didn't really hear about like companies like CrowdStrike or Alteryx or Livongo as consumers because they were mostly B2B businesses. Now, Muji, which you had on the podcast before, like he was one of the people that I came across in one of these forums, and he was posting deep dives into these companies, like really amazing technical knowledge that I couldn't hope to match. I wasn't personally very active in posting at the time because I was just starting out. Like I didn't really like it didn't fe- like I didn't feel like I knew enough about these businesses. So day in day out, like I would read more and more and more about these companies. I would look into their filings. I would go on Seeking Alpha. I would read Bert's write-ups, like other people like Ophir or Beth or the write-ups that people were posting on Medium. I was consuming knowledge and building my knowledge on each one of these different companies. And as I was doing that, I was learning more and more about these sectors and sort of getting a better understanding of how each company fits in and how the holistic picture looks. So I was then taking those skills and I was transferring them over to analyzing like similar businesses, which is why I was able to successfully analyze and understand what Livongo did. It's not a typical SaaS business. Even though it has the SaaS business model, it's a digital health company, and we'll be talking about that later. But I knew that by then that it was something that was really exciting to me, investing in these businesses and sort of understanding and evaluating like what this company did and how like all of them fit in together. And I knew that like having that big picture, like looking out 10 years ahead and seeing where these companies would be, like that's something that I love. And I knew that I wanted to do tech investing as a career. So at the time, I was working at EY right after graduation. I was doing tech consulting for them. Like I always had an interest in tech, but like I didn't have a finance background back then. And I knew that I wanted to get into more sort of the investing side of things because I really liked seeing or getting the big picture of everything and really diving into companies' strategies and competitive advantages. So back then, like since I didn't have much experience in finance, getting into the buy side was more of a dream than a realistic goal, I thought. So I realized that I really needed to build up credibility, and that's sort of what got me into posting on Twitter initially, is because I knew that even though I didn't have that experience, I did have the knowledge and I was building it up. And by posting up my portfolio on Twitter and sort of sharing my perspective on these companies, like, hey, if these companies turn out to be really, really impressive, then in the future, it would that would potentially be something that could be like sort of my resume of sorts. So I started out by really getting into the idea of providing as much value as I could without really asking for much in return. I thought about where could I add value, and that was really to start with posting my portfolio, because I really like to track other investors back when I started, to really see really find really good mentors that I could learn from. And I started by posting out my portfolio, and then I started to get like some people following me, and I was really excited, and I started to do like more content. The first of which was posting this saying that my top idea for 2020 was Livongo, and it was the stock. Like it was my largest position at the time. It was a stock that I was most bullish on, and I followed that up by writing a Seeking Alpha deep dive into the stock. And luckily, like a few weeks after I posted it, Saga contacted me, and they owned a position in Livongo at the time as well. So they contacted me and they said that they really liked my write-up and that they wanted to meet me. So I went down into the States and I met them, and then we had like a nice chat. We exchanged emails over the following couple of months, and they were really impressed with my knowledge and my commitment and my passion for investing. So in August, they offered me a job to work there. And ever since, I've been really enjoying my time there. Like it's awesome because they have the same focus, they have the same investing philosophy as I do. So like the guys are also really smart. So I am really enjoying working there.
That's awesome. Thanks for going into that. So, I mean, it's pretty crazy. 2 years from really getting into investing, and all of a sudden you have a great buy side position. So just before we get into everything, like clearly you are a learning machine and you really accelerated your learning. Like any tips or anything for people who are really trying to learn a subject super fast like you have?
Yeah, Yeah, so like I feel that it's really hard to do by yourself. You really like it really helps to find a mentor, but at the same time, like you need to find a good mentor because I feel like if you like go online, like there are a lot of people like offering advice, and like a lot of them may be like me, like people who are just starting out as well. But like it's really important to find someone, I guess, like people who really like know what they're talking about. And so like that's what really helped me get started was I went online onto these investing forums. I got knowledge from a variety of sources. I considered a lot of people's opinions, and I was able to build my knowledge to a point where I could sort of more objectively evaluate these companies. And having like the perspective of industry experts, having the perspective of these finance professionals, and bring all those perspectives together, and just forming my own philosophy based on that. That was something that really helped me. So I feel like for beginners, it's important to keep an open mind. It's important to really take your like sort of jump online and go on to Twitter. It's a great resource. There are some great like Motley Fool forums as well. I posted my growth investing sort of resource list on my pinned tweet on Twitter, so you can check that out as well. And just keep an open mind and learn um, from everywhere that you can, and really bring those perspectives together and try to form your own convictions and find out what sort of investing style works the best for you.
Awesome. So why don't we just jump into Livongo, and as some people have called it, Teledongo. Like, give us kind of the landscape, how you even heard about Livongo, and then sort of where it is today, and why you're extra bullish.
Yeah, so I first heard of Livongo, like I actually like back then in September, not long after their IPO. Like I follow like a number of healthcare investors online, and they were talking about this exciting new IPO. And at the time, I like when I first looked at it, it honestly like it wasn't really that appealing to me. Like I didn't really understand what they did. It seemed like this like people have called it sort of this electric nanny that like reminds you to like take your meds or something, and that wasn't really appealing to me. But I saw the revenue growth; it was crazy, like over 140% at the time, and the gross margins were pretty awesome as well. So that motivated me to look deeper into it because their valuation wasn't that insane. Like it was only trading at like a 15 EV to sales multiple at the time. So I looked deeper into it, and ever since then, like it's just been sort of the company that I'm most bullish about long term. And I think a lot of people on Twitter know that. Recently, they announced the merger with Teladoc, and a lot of people they weren't that bullish on the merger initially. Like they sold after it happened, and I didn't really get it either right away. Like people were asking like, why would Livongo sell this early? Like either they thought that their outlook wasn't as good as we were thinking it was, or they were seeing something in Teladoc that we weren't. Maybe Livongo was seeing something in Teladoc that would accelerate their growth more than we could have ever imagined. So after like the merger, they filed their merger filings, and Livongo was projecting some pretty insane standalone growth. Like they were projecting like $2 billion in unlevered free cash flow by 2030, and that was supposed to be the conservative case. And now, of course, if they achieved that, then Teladoc definitely got a huge bargain, and I think they did personally. And I like instead of not selling, I was loading up after the merger, and I've still been buying up until today, because I think that we are underestimating the synergies and the potential of this company by a lot. Um, so I really think that like with COVID and everything that's happened, like people have talked about how COVID has accelerated so many industries. Like you look at e-commerce, and you see like years of growth in months. And the same thing has happened within telemedicine. Like there's like a popular McKinsey study out there that showed like 50 like providers are seeing 50 to 170 times more patients now over telemedicine than they were pre-COVID. And of course, like the percentage of telemedicine visits are declining over time, but all signs point to the fact that they're going to continuously remain above pre-COVID levels going forward. And I really think that when we look back in a decade at where at how COVID changed our world, I think that sort of the biggest changes will be found in healthcare. So there's this guy like Hemant Taneja, and he's a managing director at the VC fund General Catalyst. He helped build Livongo, and he recently wrote this great book called On Healthcare, where he talks about this digital health utopia where everyone was continuously monitored by software and the patterns in a user's data that connected devices like the ones that Livongo has, or like the Apple Watch, or like all of these other stuff. They would be able to predict a diagnosis before the symptoms actually show up. And that would help governments to isolate these affected individuals in these areas and really have a more sort of comprehensive, organized approach to handling the pandemic. So when I look at the universe of digital health companies today, I see that only Teladoc is a company that combines remote monitoring and telemedicine at scale. And I think that most people, like when they hear that vision, they're going to ask, well, we like sure, this company can do it, but like it's going to be far-fetched for governments to be able to track like all of our real-time health data. Like, what about our privacy, right? Well, I also think that people thought that governments wouldn't be spying on our internet activity until after 9/11 happened. And I think that just as it's incredibly hard to prevent a terrorist attack as it happens, it's also incredibly hard to control or develop a vaccine for a new unknown virus like COVID without having major economic and societal disruption. Like, you can accelerate the development of a vaccine only by so much. It's still going to take like years or a long time. And I think that right now, like going forward, the economic and the political incentive will be aligned with this concept of health assurance, which Hemant talks about. And that's basically focused on keeping people healthy so they don't have to rely on going to the doctor every time they get sick. Now, I think that this is a massive opportunity. Like Hemant talks about the fact that he believes there will be there will be multiple over $100 billion companies within health insurance that are going to be built over the next decade. And when we look at healthcare today, it's, I think, one of the last multi-trillion-dollar industries to be disrupted. And like, there's been a reason for that. Like, it hasn't been because people haven't been motivated to try. It's because like there are a lot of misaligned incentives, there's a lot of red tape, and there's a significant lack of impetus, both from the system's main stakeholders and like average patients as well. But I think that COVID-19 was really sort of the defining moment for the industry. So like, you look at providers who were once opposed to telehealth and they're now promoting it. Like regulators also, like they are relaxing a bunch of the regulatory restrictions that made telehealth or telemedicine not that accessible before COVID. So like that involves simple things like allowing patients and providers to use telemedicine services from their own homes, paying physicians the same rate as they would for in-person visits, and allowing providers to be able to see patients in all 50 states across the US. And these changes, like they're already in the process of being made permanent. And I think that that's really going to accelerate the adoption of telemedicine. Like, I don't think that you can compare sort of what Teladoc was doing before COVID to the Teladoc that's going to be built after COVID. And like industry experts, like they're projecting like a 39% CAGR for the next 5 years for the entire telemedicine industry. Like, McKinsey estimates that like $250 billion of healthcare spend can be virtualized today. So it's clearly like this massive, massive opportunity. But like I think that the common question is then that, hey, like you own Livongo, why don't you also buy Teladoc? And Teladoc wasn't a company that I was too as bullish on as Livongo before the merger. And today, like people are still asking me, like, why don't you own Ammo? Why don't you own Cloud NV or like all these other smaller telemedicine providers? And I think that while I'm bullish on the future of telemedicine, like as I mentioned, it's going to be a huge industry. I personally wouldn't have owned these telemedicine companies by themselves. And I think the reason for that is because I really see sort of the core video or online service itself as a commodity. Like there's not a lot of pricing power for these companies, and they all pretty much offer like the same core service with low switching costs. So I think that with these telemedicine companies, their main moat is their scale. Like you look at the big four, which are Teladoc, Amwell, Doctor on Demand, and MD Live. They have a larger network of providers, and that allows patients to be able to see doctors across more and more specialties with fast connection times. Like you can see a doctor on demand 24/7. But smaller telemedicine startups like Babylon Health, they can still compete with them because they have like chatbots which screen patients before they see a doctor. And like it doesn't really take that many providers to be able to sort of provide a similar experience as Teladoc. They don't need to have the same, like the exact same amount of providers on their network. So I think that the real advantage for these larger telemedicine companies is the fact that right now, as I mentioned, regulations have allowed providers to see patients across all 50 states. So what does that mean? Well, you know, like not all areas of the US have the same access to care at any given time. Like during COVID, like you saw the damage or like the like how overburdened the healthcare systems were within like cities like New York. And during those times, like it's going to be really, really hard for patients to be able to see their doctor. Whereas in like more rural communities, maybe they weren't having that same issue. So since Teladoc is all online, they can have their national network of doctors and allow them to sort of do this load balancing where they're able to put sort of their provider supply and be able to better match that to the patient demand in any given area, any given time. So it's this whole idea of democratizing access to care. And that's pretty similar when you compare it to sort of the actual computing definition of load balancing with like companies like AWS democratizing access to cloud infrastructure. And since Teladoc is international as well, I think there's another opportunity for them to be able to potentially see patients across international borders as well. So it's really these cross-border network effects that I really think make the thesis or like make me excited about the potential for these telemedicine providers alone. I think that people have asked whether like off-the-shelf consumer products like Zoom or Twilio can eventually replace these core telemedicine providers. And my response to that would be like, I don't think that they're integrated. They're not on demand. They're sort of limited to the local supply physicians. So they don't have that cross-border effect. And like even like Amwell and like Teladoc, they offer access to care right at the beside the patient through like things like telemedicine carts or equipment like these telemedicine robots where the doctor can just put it beside the patient hospital bed and be able to access and talk to them in real time. So I think like just given all those facts plus the addition of the Livongo acquisition, which they can't come anywhere close to competing with, I think that that really allows them to go way above and beyond the value that Zoom or Twilio can provide over a long run. And I think it's also I think it also should be said that Teladoc allows for white labeling. So that means that they allow health systems to take advantage of their additional provider supply, like their provider network, while retaining the same brand that their patients have come to know and trust. So I think that while this certainly is all very compelling for these telemedicine companies, that ultimately from a consumer standpoint, which is what really matters, it's kind of hard to differentiate the care that you're going to get from Amwell or Teladoc or Hey Doctor. Now, I think that that has all changed with the Livongo acquisition. So for listeners who don't really know what Livongo does, they help people manage chronic conditions like diabetes, hypertension, prediabetes, and weight management, as well as behavioral health through the combination of connected devices, AI-enabled nudges, as well as human coaches. So to give you an example of how this would work, for diabetes, let's say patients would receive a connected blood glucose monitor that would record and upload all of their measurements with like unlimited free testing strips online, which are then going to be analyzed by Livongo's data scientists to be able to deliver customized, personalized health nudges. And these health nudges push people to change their behavior over time. And like for example, let's say like if we notice that a patient's blood glucose readings are trending lower and lower, then these health nudges would encourage them to take corrective action. And if it gets out of whack, then like a health coach from Livongo would then call the patient and get them back on track without having them to like really worry about, hey, like what am I gonna do? Or like potentially like avoiding a very, very costly ER visit. So I think like overall, this model really empowers the patients to be able to take control of their own health. That's why they call it Livongo, like live on the go. So it really empowers them to take advantage and be able to control and understand the signals that their own bodies are giving them. And Livongo, they really sell to self-insured employers. So it really is a win-win by improving outcomes for the patient, which then lowers costs and allows these employers to really have to control these very skyrocketing insurance costs. And what's different with Teladoc and Livongo is that Livongo really is a fundamentally higher gross margin business. And it's also very, very sticky. There's high switching costs because of all the hardware and the patient data, the fact that the devices like Livongo needed to get FDA approval, they needed to measure out their outcomes, their ROIs through like a bunch of peer-reviewed studies. And it takes a lot of time to cover all of the conditions that they have. So all of these are really big advantages that have enabled Livongo to leverage their first mover advantage to really scale and become the dominant player within remote patient monitoring. But I think that it's newer. Like it's a much like I think it is going to be a tougher sell to these customers, to these health systems than something like Teladoc would. And the reason for that is because it's so new, right? Like before the pandemic, people were like talking about health systems were viewing remote monitoring more as an afterthought rather than more of a necessity. And ever since CMS recently expanded their remote patient monitoring reimbursement codes to really allow Livongo to better penetrate into these health systems because they get much more favorable reimbursements. So why does all that matter? Well, I think that Teladoc right now, like they have the scale. In January, Teladoc acquired InTouch. InTouch allowed them to really enter into the health system segment, which is where Amwell has historically competed in. So with Teladoc right now, as of Q2, they said that they were in top 60 of the top 100 hospitals in the US. And they also were really gaining a lot of traction within them with 50% more client expansions. So with this large and fast expanding footing within the health systems market, it's sort of the perfect segue for Livongo to then come in and be able to get those clients faster than they would have originally by themselves. And like, I think you can already see the impacts of that cross-selling, because just a couple of days ago at the Health 2020 conference, Glenn Tolman and Jason Gorvick, which are sort of the leaders of Livongo and Teladoc, they went online and they announced that they had that Livongo had signed a new partnership with GuideWell, which was a big Teladoc client, and that GuideWell would offer Livongo for Diabetes to 50,000 Florida Blue members under their new cross-selling agreement. So I think that they both realized how Teladoc's connections allow Livongo to penetrate into that client much, much faster than they would have originally. So like I've already explained how, like why I think Livongo is sort of a more attractive business than Teladoc by itself. But I think that from now, it's important to really look at how the two businesses could produce potential synergies, like 1 + 1 = 3. And I think from a Teladoc angle, having Livongo not only confers an advantage against other telemedicine providers like Amwell. Like Amwell is currently also trying to enter into the remote monitoring space with partnerships with people like Philips, but it can't go as far as to like integrate the entire thing into its own sort of health like a telemedicine platform. And I think that like on the other hand, Livongo really offers Teladoc a way to improve their utilization, their engagement, without actually hurting their gross margins. And the reason why I say that is because historically the bear thesis, like a big bear thesis against Teladoc, has been that utilization has been very low. And before the pandemic, it was like under 10%. Like as of last quarter, it jumped to 16%, but it's still not very high. So because of that, people and like Teladoc's clients, they were really asking the question, like, why was I paying this per member per month fee for a service that barely a few of the members actually use? So that was getting into, like, that was pushing Teladoc more into these visit fee-based contracts. And since Teladoc makes much less margin on their actual visits than they would from their subscription fees, then that was a problem. Like that was a headwind for their potential gross margins going forward. So right now, Teladoc, like they derive like 90% of their total revenues from their per member per month plus visit fee model, and that's around around $1 for their member fees and around $45 per visit. So with Livongo, obviously they can charge much more. Like they can charge up to $75, which is the average for their diabetes program. And for hypertension and like their other additional services, they are value adds. So Livongo has ROI to prove that they can charge that. And as I mentioned, it's fundamentally a higher gross margin business. So now, if Teladoc wants to improve utilization, they can sort of like cross-sell Livongo into their 51 million member user base, and they can ramp up their revenues. They can maintain strong margins without having to really push more and more visits, which then would have caused them to really like hamper down on their gross margins. So overall, with Livongo, I think that Teladoc really has a very wide moat. They have because of the fact that Livongo is a much stickier business, and they also have a much better way to be able to monetize their huge member base. Because like when you really look at Teladoc, like they started within urgent care and they expanded into additional segments like mental health, and then they're pushing sort of this whole like virtual first healthcare paradigm, which really is leading the way to like for them to be able to provide virtual primary care. they announced their first pilot for virtual primary care within Q2, and they've got like a great response so far. Like they had like a 95 net promoter score. Patients were doing their annual exams on it, and they were loving the fact that it was so convenient. I think that personally, that physicals, like people can say that, hey, like a lot of the stuff that a doctor would learn on a physical could be done through something like Livongo, and that would sort of provide this continuous data stream where they would be able to really see sort of a holistic view of a patient's health rather than just doing like that scan or that blood pressure reading at that singular point in time. So that really can inform Teladoc's providers to be able to provide much better personalized care to their members, being empowered by that Livongo data. And it also allows sort of them to collect all of that virtual data. Like Livongo has 750 million digital interactions. Teladoc has 10 million annual visits in 2020. And they can combine all of that data, put it into Livongo's AI engine, and provide better personalized nudges and much better interaction. So it creates sort of this feedback loop that's going to be hard for competitors to really copy. And I think that primary care, like it's a really big space. Like 26% of US adults didn't have a primary care provider in 2018. And you see millennials, they're turning more to like digital pharmacies like Hims and Hers and Ro, which really offer that additional convenience, that privacy, and that price transparency that some other like the actual traditional healthcare system doesn't offer. So physical exams, they're being made obsolete, and Teladoc is in the perfect position now with the Livongo acquisition to really realize that vision and become sort of that integrated virtual primary care provider. And another interesting thing with this is it opens the door for additional payments models. So they talked about sort of like this fee-for-service agreement where they would sort of handle, like take charge of providing care to patients. And in turn, like these clients would pay them like a fixed fee. So it incentivizes Teladoc and Livongo to really keep their patients healthy. And at the same time, by keeping their patients healthy, they will then reduce the costs to the overall system. And without Livongo, Teladoc couldn't have done this by itself. So it really, really made sense for them to acquire them and provide sort of this integrated end-to-end virtual care platform. So I guess for like their competitors, I guess it would be hard for them to copy it. Like I mentioned, like Amwell and all these other smaller telemedicine providers, but people also talk about like EHR providers like Epic, for example. Epic, I don't think that they can copy them because like interoperability is a big issue. Like it's really, really hard to get your EHR system to connect with all of these external third-party data sources. And like around 50% of healthcare systems, they reported that they had trouble integrating information, with the main issue being the fact that it's basically hard to get everything working with your EHR system. And because that's sort of where most of the patient data resides, hospital systems, they're also not as keen to really share that data across all of these different providers. So that meant that if you want to switch your health system, like if you want to switch your providers, then like you don't have control over your own healthcare data. You don't have control over your medical data. Like it's not as easy as switching a bank. You have to like for some people, it can even be life-threatening to like not have your medical data be efficiently transported between different systems. So that's been a big issue. And because of that, I think that with Epic, it's like whatever system that they're going to be able to provide. Like they already announced that they have like their own telemedicine offerings through Twilio, but even though they have that reach, they still can't like sort of integrate all of these separate health systems, which are all in their different silos, to deliver like a really integrated sort of experience and deliver on like the stuff that I talked about with like load balancing and like integrating all of the data points together to like feed into an AI engine. Like I don't think they can do that right now. And with other like CGMs, like continuous blood glucose monitoring, like blood glucose monitoring companies like Dexcom or Abbott, or like United Health, all those insurers. Like I think like first of all, this isn't the area that they're really focused on, and second of all is the fact that like since they're also big companies, it's going to be really really hard for them to enter into the space. Like United Health, like they've made like a bunch of acquisitions, and they are trying to sort of build like this similar sort of virtual care experience with Optum. But I think that it's going to be difficult for them because they compete against so many other people, right? And like other insurers, like why would they want to like use like a United Health product? So like when patients want to like switch between different providers, then like or like different like employers and like switch their plans, like what's going to happen to all their data? And like it's the same issue, like it's kind of the same issue with cloud companies, like like smaller like Fastly, like MongoDB, Elastic, like all of these companies, they're winning against like these giants like Amazon or like Microsoft. And the reason for that is because like clients, like employees, like employers, or like these big companies, like they don't want to have like vendor lock-in. They are increasingly adopting like these multi-cloud strategies, and they don't want to be locked into a single cloud provider's platform. They also like it's not their focus, right? And they have like not as good of a developer motion and like a outreach as sort of these smaller companies would. So I think like you're going to see the same dynamics playing there, and I think it's going to be difficult for them, even though they have the reach, to be able to compete with an independent, specialized, integrated virtual care platform like the one that Teladoc offers. And I think that overall, like what you're going to see going forward is as they sort of take this approach to really managing like patients' health across these populations, producing better outcomes for lower cost, that opens up additional opportunities. The most interesting of which I think is the international opportunity with national healthcare systems. So this was talked about in their recent Morgan Stanley chat, and some of the executives at Livongo and Teladoc were talking about this opportunity to potentially have national healthcare systems as clients. And the reason why this is interesting is because recently the Singapore government, they announced a partnership with Apple where they would provide their citizens with monetary rewards in exchange for staying healthy via the Apple Watch. Now, that kind of sounds similar to what Livongo is doing, because they're also helping citizens or like employees to really manage their chronic conditions and lower overall costs for the entire system. So if Teladoc could sort of provide that integrated experience, that integrated sort of primary care role, and like take charge of like a population's health, then like I think it could be a potentially huge opportunity for them. And like I'd say one of the last points is people have like they're talking about how Teladoc's management, Livongo's management, like they don't really seem like the the next Jeff Bezos. But I think my counterpoint to that would be that this trend is so compelling. It's so big that you don't really need the next Jeff Bezos to build a pretty huge company here. Like, even though on the surface, Jason Gorvick, which is the CEO of Teladoc, doesn't seem like he has Jeff's visionary qualities, I think that he is a very big picture thinker. like you can see that within his previous interviews. He was talking about entering into chronic condition management back when they were doing their IPO. Like if you look at the March investor presentation that they released, it showed that they were going to enter into chronic condition management as part of their overall strategy. So if I had seen that slideshow at the time, maybe I would have caught on to the fact that they were going to butt heads or acquire Livongo eventually. And I think that having acquired Livongo, it was a pretty huge move, especially at the elevated valuation that they did. Like if you look at sort of the merger discussions, like Glenn Coleman, which is the founder and chairman of Livongo, he really talked about bargaining hard with Jason as Livongo's stock was rising, because they announced they pre-announced their Q2 earnings, and their stock exploded, right? Like it went from $70 to $140 within the span of a month. So Jason was really hard pressed to be able to provide even a 10% premium to Livongo's share price. But they did, because they thought about the implications that this potential merger would provide for both companies. And I totally agree with their vision. I think that generally the largest companies in the world that we've seen, you look at Amazon, and you look at the fact that they started within being a bookseller, and they soon expand to being the everything store, and they leverage sort of their capabilities within e-commerce to then expand into cloud infrastructure with AWS. And you look at Livongo and how they started within diabetes. You look at Teladoc and how they started within urgent care. And I think that overall, as sort of they combine together, it really allows them to realize the vision of being this integrated virtual first platform, where it's going to spark the conversation in the future of what stuff, instead of asking what stuff can be done virtually, people are going to be asking what stuff do I really need to go into see my provider for. So I think that overall really allows them to accelerate this combined vision. I also think that there are a couple of really outstanding superstars on the team. Hemant is now on the board. He is an amazing visionary. As I mentioned, I totally recommend reading on healthcare. And Glenn Tolman, he is also a super visionary. I've read his book. His story is very, very inspiring. The reasons why he started Livongo, because his own son had diabetes as well. And I think that together they're going to be building one of the most exciting companies of the next decade. They have they're by far the category leader. They have a $121 billion total addressable market. They have clients coming to them. They have incredible optionality with the resources and sort of the long-term vision to be able to outbid everyone else and really add on all of these additional acquisitions to further improve their platform and allow them allow these new companies to sell into their massive existing client base. And with now the Livongo acquisition, they branched out of telemedicine, and they are now able to offer a very wide moat, a very unmatched value proposition that I think that even the biggest companies would be hard pressed to really replicate.
Yeah, thank you so much for going through that. That was great. You asked yourself the questions. I just sat back and listened to you. That's awesome. But so just give us a vision or a picture of what could be possible in terms of healthcare, in 10 years. We wake up, what is Teladoc/Livongo going to enable?
Yeah, so I think that going into the future, healthcare is going to become more and more virtual. People are going to be again, they're going to be asking themselves the question of what do I really need to go into the hospital for? These days, there's such a focus on going into the hospital for everything because of course the doctor knows best. But as patients, as consumers are being empowered to really take control of their own health, they're going to be able to provide and take care of themselves, and manage their conditions better than having to go into the hospital for. So, like, I think that everyone has a story of them like going like having like sort of a minor condition like a bee sting, and then going into the hospital, getting it checked out, and coming out with this crazy bill. And I think that knowing like that, so the possibilities, the potential that virtual care offers with this combined entity are really exciting, both from like my own personal standpoint as a consumer, as well as the potential for like these employers and all of these other like healthcare systems, which are really spending and paying out these ever increasing premiums to really be able to save money and improve their own sort of health. And I think that like within within 10 years, like having your sort of condition, like your health being monitored 24/7, and having sort of this doctor in the cloud be able to really know and predict your health and your health outcomes before you even know yourself, and then being able to provide actionable advice for you to be able to really engage and like proactively improve your own health is going to be something that's going to be really appealing with a lot of consumers, because people like these days, like there's such a focus on wellness. Like you see with things like Peloton, you see with things like Apple Watch, like people are so passionate these days about promoting a healthy, active lifestyle. And that's something that Livongo and Teladoc offer as well, in terms of changing the healthcare system to one where it's easy, it's convenient, and it's delivers a superior value proposition.
Awesome. So, I mean, it's pretty clear you're even talking about, regulation that's been changed, the CMS, and all sorts of things. Like, what are some of the best resources for listeners who are maybe new to the healthcare space? Like, what are some resources that have really been helpful for you?
Yeah, so like there are a ton of great people on Twitter. Like there's a very active community of both healthcare investors, healthcare VCs, as well as people who actually are working within the digital health space. So for me personally, like with Livongo and Teladoc, the way that I approached investigating that company was pretty much sort of the same way that I would approach any company, really. It's like it would start out with looking into their company filings, looking into like different articles, and I felt that like really doing like my own write-ups and being able to sort of gain sort of this like understanding of these two companies and put it into words, and really engaging with the people on Twitter and like having them ask me questions, and really sort of answering them and prompted me to think about things that I may not have thought about before. I think that that really has helped me to really become more of like really sort of build my knowledge in this space. So I think that, yeah, like there's a ton of good resources on Twitter, and people can always reach out if they have any questions about these companies.
Awesome. So, my closing question is, how do you have a daily habit that has really helped you out?
Yeah, so like I feel like like when I was working at EY and like full time, like it was hard to really get sort of the time to really investigate and research all of these companies by myself. And like I was working like 50-hour weeks, like 50 to 60-hour weeks, and investing like it was something that I would do in my free time because I actually enjoyed it, and like it was something that I was really passionate about. So just being able to I guess spend the time to be able to put aside like an hour each day just to read and be able to like it could be something as simple as like going on Twitter, or um, like like chatting with fellow investors on like online investing forums and like putting aside the time to like really read and improve my knowledge, I feel like that's something that has really helped me. Like if you're like if the listeners of this podcast they want to sort of get into reading, like one book that I really recommend is Seven Powers. I felt like it has really contributed a lot to my own personal investing philosophy. As you know, a bunch of the sort of um, my approach is really focused on in-depth qualitative analysis because like I really want to invest in the highest quality companies. Like I feel like overall, like the market expects for the average company for the return on invested capital to trend towards the historical average over time. But when you have companies with very durable competitive advantages, these companies can potentially continue to deliver a return far above their cost of capital for way longer than can be reasonably expected. You look at companies, compounders like Zoom, like Shopify, Amazon, Facebook, these are bargains in plain sight. And by looking at competitive advantages, that really helps me to identify what companies will be able to continue to outperform over a long run. So just a quick summary of the book. It's by Hamilton Hemler. He runs his own fund called Strategy Capital. They've produced an insane like 40% CAGR over the past like 20 or so years. And he really talks about these 7 competitive advantages that businesses can have in order to really outperform over the long run. So the first is scale economies, like economies of scale. That basically means like declining unit costs as the business scales. You can think of Netflix and how they have fixed content production costs that are being spread out across more and more subscribers. Second is network economies, and like that's basically the network effects. So you can think of like Facebook, where the value of the product keeps increasing the more people use it. When I use Facebook, a bunch of my friends are also incentivized to come on and join me as well. The third is corner resource. So that's having exclusive access to a very unique resource, whether that be a patent or human capital. In the book, he mentions Pixar and how their team really helped them to stand out to the point where Disney had to acquire them to revitalize their animation studio. And the fourth is branding. So he talks about how like very popular brands that are being built like Tiffany are able to really have unique pricing power, and consumers are really willing to pay up for this perception of high quality. And fifth is switching costs. So having a very, very sticky product, things that consumers can't really switch from without having to incur like pretty high costs. You can like he mentions the example of SAP, and other like ERP systems are also like pretty similar. Like there's a like even though they can be very, very hard to use, the cost of implementation is very, very, very high. So people stick with them over the long run. And you can think of the last one as process power. So that's something that's really embedded process or organizational structure or methodology that really lowers costs or produces a superior product that can't easily be copied. And he mentions the Toyota production system as something that is process power, because like even though Toyota sent like engineers all over the world to like GM and stuff, they like GM couldn't copy sort of Toyota's process.
That's awesome. Yeah, thanks for going over that. I think it's a great book and a great place to end. Thanks so much, Richard.
Yeah, thanks, Ryan.